Hi guys, welcome to As Simple as Possible. In this video, we are going to revise chapter 8, which is divisional performance and transfer pricing issues. The first topic here is responsibility center. Responsibility center is a part of organization. It is headed by manager having direct responsibility and can be held accountable for it. Responsibility accounting is a system of accounting that segregates revenues and costs into areas of management responsibility to control performance. Next we have is the type of responsibility center, cost, revenue, profit, investment. In cost, managers are accountable only for the costs that are under their control. In revenue, they are only responsible for sales revenue. In profit, they are responsible both for revenue and costs. And in investment centers, managers are responsible for profit and working capital, fixed capital investment. Next, we have difference between reporting of divisional versus managerial performance. Divisional is evaluated on items which are directly traceable to the division. In managerial, we only base the items that are under managerial control. For example, if in divisional we have 20 rupees that is not traceable and 20 rupees that is not under divisional control, and rest is 60, we will use 80 because we will not include the one that is not traceable. Next, we have return on investment, which we also call return on capital employed. When we do a corporate analysis, we use the term return on capital employed, and when we do a responsibility center analysis, Then we use return on investment. The formula here is controllable divisional profit divided by divisional investment. Problems with this is dysfunctional behavior, new projects have an impact on investment but may increase profits over time, due to which we may make a wrong decision because then we will avoid this investment. Second is that current ROI can be artificially increased if division underinvests. But that is not a good factor that we should consider. Next is residual income. It has less dysfunctional behavior than ROI because all projects are allowed if R is greater than cost of capital. It gives a hurdle figure for profit which is based on minimum required return from a division. If controllable division profit is 100, imputed interest is 40, then the residual income is 60. How did we arrive at imputed interest? If 200 is the investment and 20% is the cost of capital, then 40 is the imputed interest and hence we get 60, which is the residual income. Now we will read what are the advantages of residual income. Residual income is more flexible. Different cost of capital can be applied to evaluate different divisions with different risk characteristics. What are the weaknesses of residual income? Does not facilitate comparisons of different sizes of divisions. Next is difficult to decide appropriate capital employed measure on which to base imputed charge on. Next is reason for using return on investment more often than residual income because it is more consistent with corporate assessment, more easily understood, it is more appropriate for comparing organizations of different sizes, and it is less costly and time taking than residual income. Now we will study what are the problems common to return on investment and residual income. Calculation of profit, calculation of investment. Profit has to be adjusted to reflect controllable and traceable items only. Both ignore tax. Transfer prices or quantities may be set at non-commercial rates. Investment discourages replacement. Cash is controlled by Treasury Department. And last, difficult to value intangible assets. Next broad topic that we have is economic value added. The formula for economic value added is non operating profit after tax minus capital change. And capital change is WACC into net assets of beginning. We know that the main objective of the company is to maximize wealth of shareholders, but we generally use profit based measures. But we should not use them because profit ignores cost of equity capital and it does not reflect wealth created. When we use NOPAT, there is a difference between the way NOPAT is calculated compared with profit figure for residual income. Investment for future added back for economic profit but normally would be treated as expense. For example, research and development, advertising. Next that we have is cash versus accrual accounting. In normal accounting, accrual items are included, but in cash accounting, only cash flows based account amounts are included and it excludes accrual accounting. Third difference is accounting depreciation we add to profit and economic depreciation we deduct from profit. Automatically we have to adjust non-current assets also. Economic depreciation is a true reflection of change in value of assets during the period. Tax paid is deducted. Tax paid is deducted because we have to deduct it as per the cash terms. Interest is excluded from NOPAT because interest costs are taken into account in capital charge. Hence, NOPAT is profit after tax plus goodwill amortized plus research and development expenses, advertising expenses, non-cash items plus depreciation, but economic depreciation will be charged plus interest net of tax, or we have another formula, profit before interest and tax minus cash taxes paid on operating profit, add goodwill amortized plus research and development and advertising plus non-cash items plus depreciation. Next that we have is assets. Assets are valued at opening year value and at replacement cost. Asset base plus cost is capitalized. Remember, when you are making adjustments to expenditures like research and development, advertising, and adding them back, then similar adjustment needs to be made in capital employed in that year also. Next, we have evaluation of economic value added. Advantages, disadvantages. So, in advantages, we have that it calculates return in line with shareholder expectations. It replaces multiple goals. It encourages long term benefits. It removes distortion, and it is consistent with NPV. Next, we have disadvantages. It is complex to calculate. It is based on historical data. It is inconsistent with published financial information, and interdivisional comparison is difficult. Next topic that we have is transfer pricing. When there are divisions and they supply goods to each other, the price that at which these are transferred is based on transfer pricing. Why is this done? Because we have to control, to keep check on the amount of resources being used on that particular work done by a particular division. It is also important. So first it is important because of controlling, and second for performance measurement. Fairly otherwise, revenues profits of that providing department will be understated and other receiving department will be overstated. To ensure that there is no distortion in performance measurement of the division, last point is for motivation of managers and to avoid damaging the interest of the company as a whole. Next that we have is aim of transfer pricing. The first aim that it has is goal congruence. Between divisional and the other firms, because they will individually try to do their best, which will sum up as a whole. Hence, the transfer price must equal to the true cost. Second goal that it aims to maintain is retain autonomy by not forcing internal transfers. Third, permit performance evaluation of divisions, preventing unfair impact on performance measures of either division. Hence, transfer price is equal to cost price or market price. Next that we have is cost based methods of transfer pricing, necessary if market price is not available. Actual versus standard cost. The problems that are in actual cost is that it cannot be determined in advance before the manufacturing is completed, and no cost control is there in selling division. Standard variable is used when marginal cost of production is used if spare capacity is there and there is no external market to sell that. Full cost is equal to variable plus fixed overhead and plus sometimes markup. Using full cost leads to high transfer price, and also fixed cost must not be included in the analysis because it is not relevant, and hence it will lead to wrong decisions. Next topic that we have is dual pricing and two-part tariff systems. We know that fixed cost is not used in marginal cost based transfer pricing system. But then we have two types of marginal cost based transfer pricing system. One is dual and one is two-part. In dual pricing, external markets exist. So the selling division credits market price and the buying division debits variable cost. In a two-part tariff, the transfer price is set at variable cost, and once a year there is a transfer of fixed fee to the supplying division. Hence, it allows for the fixed costs. The third approach that we have is market-based approach. To transfer pricing. If market price exists, that will be the basis for transfer. When supplying division is at full capacity, if market price exists externally, and in that case it includes advertising costs, then we should adjust it from the market price in case of an internal transfer. So if we are using market price as our transfer price and we are transferring internally, then we have to see if that market price includes the advertising cost, because that has to be reduced if we are transferring it internally because we are not incurring it. Next approach that we have is opportunity cost approach to transfer pricing. In this we have minimum transfer price marginal cost to selling division plus opportunity cost of resources used. If external market exists, then contribution lost. If there is no external market, then opportunity cost is zero, and then if that price is more than the market price, then we will buy it from the market. So this is all about this chapter. I hope you like the video. Thanks for watching.